speaking with Thomas Goldblatt. He's the founder and managing director of Ravinia Capital. Tom, today, as you mentioned, you recently closed a transaction.
Yeah.
If you can give us a brief overview of the client and how you sourced this deal.
I would be glad to. It was probably the I've probably worked on over 100 deals in my career, and I have to say this was the most interesting, difficult, challenging, and fun I've ever had. So it was really a challenge, and I enjoyed talking about it. So what happened with the transaction that you're referring to was it's an industrial staffing company called Employment Plus, who's based out of Bloomington, Indiana. So this is a company, they provide staffing, laborers for companies like Honda or Wabash Steel or other big companies, and it's a growing market. More and more companies are wanting to use staffing to basically have them handle things like workman's comp or handle healthcare benefits and other reasons. So it's a good industry. This company that we were working with had basically started as a family business, family owner, and through their formula, which is a good formula, which is basically they think a little bit more about the placing the right employees at the right place, they had grown rapidly. Well, they'd grown actually too rapidly, and so there's a lot of lessons to be learned there, but they were always behind in the capital. So they never had the capital to actually to grow. So you need to get the capital first and grow. So they did that wrong, and then also they grew so fast from a $25 million company to a $350 million. They didn't have the proper management either. So they just went from being a sole proprietor run, hands-on everything, to a much larger company. The problem was that the accounting people were not up to snuff and made several errors. Now these errors resulted in a situation where this company, its line of credit had grown from 10 million to 30 million, and it had missed some payroll taxes, which ended up meaning that they owed governments a significant amount of money. So as you probably know, that's one of the worst things that you can be in, is where you owe payroll taxes, because payroll taxes are considered to be the government's money, and when you miss paying them, they consider it a theft. So you actually can go to jail for that type of thing. The other thing is, and as I mentioned, we deal with a lot of special situations, it creates a real murky situation of what happens in a bankruptcy. It's unclear sometimes, depending on the state, whether the bank actually would have full priority on everything, or whether the states would get priority. Basically, it's kind of a murky situation. So the way we became involved in this, and it's kind of an interesting story as an aside, so I do a lot of networking, I think it's no secret.
Everyone knows you.
Yeah, that's right. But what, this kind of, it goes to the old, I like to say the slogan, it's not what you know, it's who you know, so I have like a law degree and a CPA and MBA and stuff. But the way I got this transaction was a bankruptcy lawyer that's a friend of mine. One morning, 3 years ago, a couple months ahead of St. Patrick's Day, say, getting a group together, and usually we dress up in the same thing, and we go around St. Patrick's Day in Chicago. I'm going to have other my clients and referral sources like bankers, are you interested in going? And I'm like, well, that seems different. So it also was like in my neighborhood. I live in Lincoln Park. So he ordered 6 gecko costumes, basically, so green geckos, and went out that morning. The funny part is, like, my kids are like, well, where are you going? I'm like, I'm going to work. So it's 10 a.m. And the thing, I went out to the Lincoln Park bars and as a gecko, and the thing I really learned about that is that it's a lot of fun to be dressed as a gecko. Everybody wants to take their picture with you. So I had a good time. Now one of the benefits of this is, and kind of telling this a little longer, because it just shows how random networking is. But one of the other geckos was a guy that's now a good friend, Jason Lavoie, who's at Wells Fargo. He happens to be in charge of all their factoring for the whole Midwest. At the time, he just seemed like a nice guy. So we got together later, and about a year later, I was, I remember I was at a Cub game, and I get a call from Jason saying that he really likes the staffing company, and they want to make a loan, but they need an additional mezzanine loan on it. And so that's something we do, is help companies find financing. We help them figure out what to do in the difficult situations. So Eric Welshko and I, we work together. So we started working on the company and started meeting the people at the company, and we started on trying to see if we could basically find them some mezzanine money. Well, it turns out, actually, that we're starting to work on the company. We're seeing that it's going to be very difficult to get the mezzanine finance because they have the back tax problem, coming off losses. There's just not a lot of assets there. But we're trying to figure it out, and we know a lot of different mezzanine lenders. Well, then we get just like all of a sudden a disengagement letter from the company, saying that, and we're like, what's going on here? So we call up the company, and they said, well, we had this other guy come in and he says that he can get us an asset-based loan. And we're like, well, we can get asset-based loans, but you're not going to get an asset-based loan. And they said, well, they said we're going to have it, and we can have it by, August. And I said, look, I'll tell you right now, you're not going to have it. You guys just lost 2 months because we're having trouble getting a mezzanine loan, but here's how it's going to play out, and by August you won't have it. And so the thing is that we stuck with it, and we continued to give them good advice, and so we kept driving down to Bloomington, Indiana, and we became friendly with the owner of the company and the CFO at the time, kind of telling them, what to expect. Mm-hmm. So we became kind of an advisor and telling them how to go. So what happened is that the company then was, thinking that it could get itself out of the trouble. And then it ended up that we were there and we were talking about things that could happen. And they said, like, no big deal. We got a forbearance agreement from the bank. We're like, whoa, hold on here. This is big news, And so what we did then is started to advise them and come up with a strategy, basically, to say, look, you don't have to basically accept what the bank says. They have lender liability. You have your own thing. So let us kind of keep advising you. Let us help you with the bank to, try to get more time. If we can finance it, we can. But in the meantime, we'll be going ahead with a process. And so, that's what we did. We were looking for the best possible solution in the thing. Now, what we saw in this situation was a company, although it had just, very poor books and records, and it actually lost money and owed a lot of money. What we saw is that there really here is something very valuable. There's really a good company underneath. That's why it grew so fast. Mm-hmm. And so we felt that if we could basically have the time, that the best way out for everybody, because there was no good way out for the bank, for the owner, for the taxing authorities, is to let us have time to basically come in and kind of bring in outside people, and this is where we brought in the Grant Thornton people to help, and kind of redo the books and records so it's basically, they were doing, for instance, their accrual accounting almost like on a cash basis, so just there'd be wild swings. So the books and records, they weren't accruing to it. I could go on and on. But let's just say, we thought that we can basically solve. We could add credibility to that. And we could basically work on the turnaround plan in the meantime. And the company had already begun that with the help of the bank as well. So they were raising pricing, and the good thing is they weren't losing customers because they were underpricing to begin with. They devalued just how valuable that their service was. And so we basically said, give us time to show this, and we started to project what the run rate and what the earnings would be once the turnaround is complete and once we kind of rid the company of the companies. And we saw this is a pretty big number. Although they had lost money, we can show this is making a pretty good amount, and we feel pretty confident that's what's going to happen. In fact, it's going to be even better for somebody that comes and acquires them, because they can basically just take their great way of going to business and they can kind of merge together the overhead. And the accounting problems won't be a problem for the future people, because and we brought in temporary people to work, running the accounting department during the meantime as well. And so we felt that there's something here. Now everybody was saying, Tom, you're putting lipstick on a pig. And I took great offense to that. I said, no, what we're doing here is we're wiping away mud from a beautiful swamp. And that's really what we were doing. So we basically then went through, our strategy was, getting back to what I was talking to earlier, I knew from being on the private equity side just how vulnerable this company could be. Because at any time, any of these authorities could basically put a lien on the company. It was like Russian roulette. You're done. Because we're talking about a staffing company here. There's no machinery or anything. This is if customers get the word out, and believe me, it's a very competitive industry, they'll use what they can against you. They'll say this company is going to fail. Customers could leave in a day. So it was very vulnerable. We had to work, really as hard and fast. And also an interesting thing is, when you're dealing with a very large amount of money on a deal, people's morals go out the window. They feel justified doing anything. So you really had to be tough and protect your turf. Because people were looking to try to get the bank to do a bankruptcy and try to put it through a process and say to the banker, look, we'll give you all the future loans. One thing that we got very lucky with is that the bank, First Capital, Jay Atkins, the banker at First Growth, he ended up to be an extremely upright guy that recognized and bought into our idea of the process and invested in the process. So if we would have had a less strong-willed banker, or we would have had one with less, let's just say less morals and honesty, there's many times that people would have basically, the banker could have basically taken the company and to the detriment of everybody else. Maybe been good for him, but wouldn't have gone through. Same thing with the owner of the company. We were lucky that that person was very admirable, and because many buyers would just try to bypass me and go to the buyer, the seller, and try to get him to go through a process. And it would be somewhat illegal, so it's a good thing and important. They fully understood all the bankruptcy laws and all the different alternatives, because what they were trying to do is say, look, you're never going to get out of this mess. So declare bankruptcy, we'll basically pay you on the backside. We'll give you a $2 million salary, or we'll pay you on the goodwill. Well, that would be a fraudulent conveyance or preferential preference. So that wouldn't work. But I had to fend that off, and we had to spend time. So really had to be tough about it, because it was a very vulnerable situation. But as far as collaboration, we brought in Grant Thornton to help. They did a wonderful job. I've worked also with a lot of their competitors, whether it's McGladrey, BDO, Deloitte. I can say the same thing about them. The people in that industry are very strong, and you'd be making a mistake these days, even in a healthy deal. Because of what I was talking about before, I think to do a deal now without sell-side diligence. Because you're just going to end up misrepresenting your client. You're either going to have a lower price or a broken deal. So we collaborated with them. And what we did basically then is the strategy is we basically wanted to present the company as best. And we wanted to basically explain all the problems. We wanted to be very open about them all. And we wanted to, so we did a thorough diligence, and we wanted to have a quick closing as much as possible. And we also wanted to try to run it as an auction, which is very unusual. So the auction, it's common in Europe. It's common with distressed deals. In fact, it's required by law. If you go through a bankruptcy, you need to run an auction, because they need to be able to show that they got the highest and best price for the creditors. And there's a reason, because the auction works. It's done in real estate. But because of custom, it's very unusual. And buyers hate it, because they don't want to have the idea of having to compete, And so what we wanted to do, though, we used the auction not so much that we really wanted to actually have a physical auction, but by maintaining the leverage of never letting a buyer get the exclusive. So they always knew there was competition. It allowed us to kind of drive up the price, but it allowed us to keep the company from ever being so vulnerable that somebody could have a lot more time. So we ended up doing that. We did a lot of things to kind of maintain control and keep, one of the things that we did, for instance, and this is another collaboration, is when I was buying companies with Monomoy Capital Partners and Fingston Partners, all the time we'd have these deal calls, like after you sign the NDA, and you have a call with management. And so it's almost always an hour call. And you basically get the CFO and sometimes the management, usually the investment bankers on it. And you have these calls and you ask them a lot of questions. And you go through the hour, and usually it starts about 10 minutes late because people take a long time getting on the conference call, and then it turns to chat. Now, on almost every one of those calls, I realized, first of all, it was like really wearing on the management, and it was really weird. But then I'd call up the guys at the PE firm, well, what do you think? And they'd be like, nah, not for us. And you'd be like, why did we waste an hour? So the thing is that also because we had so many different difficult parts and stuff with this deal, that one of the things we did is that instead of just letting everybody go willy-nilly and not present it first, and we want to present the best case, we eliminated those type of calls and we had a live webcast instead. And we had basically 55 buyers sign in, and what we did is we didn't take any chances. We scripted it, we practiced it many times, we had mock questions, and the thing is, on this webcast, the buyers couldn't see who else was on there, but they basically could hear us live. And I think also because it was novel, we got a lot more interest, but it allowed us to present it in the best possible way and have all the best players. We had all the bankers there, we had the Grant Thornton people, we had the consultants, so we were able to really express and show it with graphs and everything. So that was one of the things that we did to maintain control. There's some things I did I can't disclose, because I got to keep those tricks for the next couple deals.
That's a great example of using technology to speed along the deal process.
Yeah. So we ended up, and it's interesting, selling a company is a lot like dating, well, at least for me. I mean, well, and I shouldn't say that, I've been married a long time, but it's what I remember of it. But let me say that what I mean by that is that when you show, when a potential buyer thinks you have another buyer, they're real interested, and they're real nice, and they really, they're giving you more little things towards the deal, and talk, but as soon as they think you really need them, they're going the other way, things that you thought they agreed to. So you really have to maintain this balance of showing a certain amount of disinterest, and that there's always somebody else, because as soon as any type of buyer thinks that they basically have the leverage, then you're going to start to lose on all the points, and the only way you're going to win something is to be able to talk about kind of leaving the room, which is takes a lot of guts.
It's very interesting.
Yeah. So in the end, with this deal, we ended up being able to run a quick process. I mean, the beginning part took a long time because we wanted everything right by the time we went to market. We had a lot of detractors. We had some people saying, we'd be lucky to get 20 million, 30 million. It's interesting, we always had faith that we were going to be successful. Never doubted for a minute, until like the last week, really. Because if you don't have faith in what you're going to do, and basically that's the only way you could see. So somebody presents, no, this isn't going to work. You kind of look, what? How could that be? Of course it's going to work. So we basically were able to run the process and end up selling the company for around 80 million plus potentially 20 million more in earn-out. The bank got paid off entirely. They ended up getting a nice fee. The tax authorities all were paid off, and jobs were preserved. The owner now has all his obligations are paid. He's going to make a lot of money. He's working for this much bigger company, so it all worked out.
Great.
So we're feeling pretty good.
Great. And now, one last question. Are there any interesting takeaways or lessons learned from this deal?
Well, there's quite a few lessons learned and takeaways, and I think, like I was saying about maintaining leverage, I think is having vision that you know what it's going to be. It's having patience. If you have the right solution, basically try to find, let other solutions happen and try to help in any best way you can. The best solution is going to win out. Also, as far as networking goes, it's like, be yourself, have fun, be friendly, be looking out for others, and good things will come around to you. I think the basic lesson though is just believe in what you're doing, believe in yourself. Don't let people kind of talk, and just drive to what you can do, and you can amaze yourself what you can achieve.
Great, Tom. Thank you so much for taking the time to speak with us today.